Today, we are popping the hood on one of the most iconic brands on the planet, Ferrari. We're going to break down a professional investment analysis to figure out if this luxury giant is a golden opportunity or maybe a bit of a warning sign for investors.
So the prancing horse has definitely hit a speed bump. Its stock, ticker symbol RACE by the way, has skidded almost 16% lately. And that brings up the big question for any investor. Is this a red flag telling you to stay away, or is it a green light to floor it?
To get to the bottom of it, we're not just going to guess. We are diving deep into a detailed, multi-factor investment analysis to give you a really clear look at what the pros are thinking.
Okay, first things first, let's get a handle on the situation. Just how bad is this recent drop and what could be going on here?
And you can really see it here. There has been some serious short-term selling pressure. I mean, a drop of almost 16% in just the last 4 weeks, that's definitely caught the market's attention, and it builds on what's been a pretty pessimistic few months.
So we've established that the stock's taken a hit, but now for the really important part. It's time to pop the hood and see what's actually going on with the engine. Is this just a paint scratch, or is there a real fundamental problem?
Our first diagnostic tool is something called the P/E ratio. And look, it's actually pretty simple. Just think of it like a price tag that tells you how expensive a company is compared to the profits it makes. A lower P/E means you're getting more profit-making bang for your buck.
And this is where it gets really interesting. Even with its super luxe status, Ferrari's valuation is actually looking more and more attractive. Its PE has fallen from a peak of nearly 65 all the way down to 45.9. That's its lowest point in over a year and a half.
So you might be thinking, okay, the stock's cheaper. Does that mean the business is struggling? Well, not even close. Ferrari's earnings per share have just exploded, up an incredible 28.8%. That is nearly double the growth of the entire S&P 500. This engine is firing on all cylinders.
And it's not just us saying that. This incredible performance has earned Ferrari a Zacks rank #1, which is a strong buy rating. That puts it in the absolute top tier, the top 5% of all stocks when it comes to earnings momentum.
But wait, a good investigation means you got to look at everything, right? The good and the bad. And we found something that might make you pause. Top execs, including the CEO, have actually been selling their shares. That can sometimes be a red flag, so let's dig into that.
The analysis says this is the answer, and it is huge. A massive, new 3.5 billion euro share buyback program. And that's on top of the almost 2 billion they've already spent. When a company plows that kind of money into its own stock, that is the ultimate vote of confidence from the inside.
Okay, so the investigation is pointing to a really healthy company that happens to be on sale. Now, what's the game plan? How does the analysis suggest capitalizing on this?
So the analysis recommends a really disciplined 3-step entry strategy. First, you start accumulating a position right around the current price. Second, you add a little more if the stock dips into what they call the optimal value zone. And third, you complete the position only after the stock proves its strength with a breakout.
And look, getting in is only half the battle. You've got to have a clear exit plan. This analysis outlines 3 distinct profit targets: a conservative target for a 15% return, a base case scenario for about 24%, and then a bull case where things go really well, aiming for a 37% gain.
This quote from the analysis just sums it up perfectly. Yeah, the execs sold some shares, but that's more than offset by this gigantic buyback program, which they call the strongest management confidence signal available.
But you know, every race has its dangers. A winning strategy isn't just about going fast, it's about staying on the track. So let's look at the safety measures built into this plan.
The plan includes a really solid safety net. There's a hard stop loss at $372. That's your non-negotiable exit if things go wrong. Then there's a trailing stop to lock in profits as the stock goes up. And finally, regular 90-day check-ins to make sure the original idea still makes sense.
All right, we've looked at the situation, checked the company's health, laid out the strategy, and we've got our safety net. So now it's time for the final verdict. How does the risk stack up against the potential reward?
This table breaks it all down. The analysis gives a 20% chance to a downside bear case, with losses limited to around 9%. But look at the other side. There's a combined 80% probability of positive returns, anywhere from 25% to almost 40%. This is what you call an asymmetric bet, where the potential upside is just so much bigger than the potential downside.
And if you're a visual person, this chart makes it crystal clear. The odds are just heavily skewed towards a good outcome.
The analysis suggests there's an 80% chance of this being a profitable trade, with that base case being the most likely scenario.
So let's just boil it all down. Why does the analysis call Ferrari a high-conviction buy? Well, it comes down to these 5 things. Its valuation is at an 18-month low. Its earnings growth is crushing the market. It has a massive buyback program. The stock is technically oversold. And finally, it's got that amazing risk-reward profile.
So the analysis lays out this clear, data-driven roadmap. It suggests that Ferrari is a high-performance machine that's basically on sale. But in the wild world of the stock market, nothing is ever a guarantee. So the ultimate question remains, is this a calculated risk you'd be willing to take?